Hi everyone, I can see we've got a few attendees already joining, which is great to see you today. I'm really pleased you're able to join us. Whilst we're just waiting for a few more attendees to come into the webinar, Vicky's going to pop a poll up for you just to complete, to let us know how you feel about reading your reports and understanding the financials in your business, just so we can take a bit of a temperature gauge of who's in the room and how confident they are with some of these financial statements that we're going to be talking about in a little bit. We are recording this webinar, so if you want to re-listen and you're wondering, if something that I said a bit too quickly and you want to go back and listen to it again, you will get a link to the recording afterwards, so don't panic. And you may have also noticed that in your Eventbrite invitation, there was a link to the workbook, which you can download and use whilst we're talking today. It's got all of the slides on it and you can write against them. But if you don't get that, that's not a problem either. We'll make sure that you've got copies of the slides for afterwards. So if you just want to listen today and then write some notes as you go along and have some thoughts as you go, you can just do that as we talk. I can see we've got lots of attendees already arriving, which is wonderful because you're absolutely on time. So we're not going to hang around for too long waiting for people to join because we've got a lot to get through today. So in just a minute or so, we will get started. Hopefully those people that have just joined, hopefully you can see that poll. If you've got any problems with that, just put your hand up or pop something into the chat, and Vicky, who's here with me today, can help us make sure that we navigate that so everybody's got access to the poll. Okay. Vicky, I think we'll probably get started. So if you just give me a moment, I will start sharing. Hopefully you can see my screen. Vicky, can you just give me a thumbs up?
Yeah, that's great.
Fabulous. Okay, fantastic. So I'm hoping that everybody can see how we're doing. Welcome to Know Your Numbers.
Right, hi everybody. As you've probably already gathered, my name is Vicky and I'm the Operations Director here at Panthera. And I'll be the moderator today. Probably most of you are familiar with Zoom features now, but I'll just quickly point out the audio settings there, the chat you can use if you'd like to. You can raise your hand at any time, and questions and answers we'll be doing at the end. So I'll keep an eye on it though. Brilliant. And now I'd like to pass you over to Tori Wagg, our director. Thank you, Tori.
Thank you so much, Vicky. So if anybody's got any questions as they come through, Vicky can always give me a heads up if she needs to stop me. Now, today's webinar is called Know Your Numbers, and it's pretty action-packed. We've got quite a lot to get through, so I'm going to keep us moving on. But I'm very aware that a lot of the things that people struggle with around Know Your Numbers is the accountanese that we use. We try really hard at Panthera not to do that, so to translate into everyday language as much as we possibly can. But if we do make that slip and we start using words that you don't understand, please pop any questions about terminology into the chat as we go, and Vicky can help to translate as we go along. So I like to begin our webinars with a thought for the session. Before we get absolutely started, my thought today is the budget is not just a collection of numbers, but an expression of our values and our aspirations. So hopefully you've all updated your budgets and forecasts for 2022 to reflect the challenges of the current financial climate that we find ourselves in. These numbers express your aspirations for the business over the next 12 months, maybe 36 months if you do a 3-year budget. And now is the time to make sure you can understand monitor and measure what you've set in those budgets and forecasts. Now, I like to come back to the fact that they are a representation of our values and our aspirations. And I'm just going to share with you what our values and aspirations are at Panthera, just to give you an idea of what that would look like perhaps in your business. So our aspiration, our purpose at Panthera is to help our clients to thrive so that they can achieve their goals. And alongside that, we have a statement of our values. Here's a picture of all the values that we have. And they are to make things clear, to be here to help, to respect people's time, to work together, that details really matter, and to build sustainable businesses. And these 6 underlying values help us to drive forward our forecasts and our budgets in the business. So we really don't sit down and do numbers until we've worked out the kind of core of what our business is all about. And if you haven't done that bit of work, if you haven't worked out your values and the purpose in your business, I'd really urge you to go and do that, or reach out to us. We do some workshops to help clients to really work out what those values and purpose is in their business, because once you know that, it's much easier to work out where you're going to go. So the agenda over the next 60 minutes, we're going to cover the importance of knowing your numbers. We're going to have an overview of the different reports that you should be producing or that might be put in front of you by your accountant, and the difference between profit and cash. And if there's one thing that you get to take away from today's webinar, it's a better understanding of the difference between profit and cash. I would be absolutely thrilled, because it's probably the question that we get asked the most by our clients. Why is what's on my profit and loss account not how much is in my bank account? So if we can really crack that for you guys, I'd be thrilled. We're also going to talk about the key drivers of the value of your business, how to protect your assets, and how to adopt some best practice around your financial awareness. We're going to outline some potential next steps for you to take to make sure you truly understand your numbers. So please make sure you take lots and lots of notes today. Some of what we talk about might sound a bit like a foreign language. So if any of those terminologies come up and you think, gosh, I've never really understood what depreciation means, pop it in the chat and we will help you through that, and we'll answer some questions at the end. Why do you need to know your numbers? So for me, knowing your numbers is absolutely vital. It allows you to interpret your reports and know if you're on track to achieve the goals that you've probably set in your business plan. Now, if you haven't set goals in your business plan, again, that's something that we could help you with if you want some advice about how to go about writing a really good, robust business plan for the next 12 months. So here are my top 6 reasons why you need to know your numbers. They're going to tell the story of your business. They allow you to interpret the results of your business activity. Number 2, they help you to identify the symptoms versus the root causes. For example, you might see a decline in your gross profit, and that might be a symptom of a root cause such as your pricing being wrong, or there's some inefficiency going on in the way that you make the thing that you sell, or you do the thing that you sell. You might be purchasing really badly, so your suppliers might have been putting their prices up and you've not reviewed that, or you might be wasting things. Number 3, it's early warning signs. Knowing your numbers enables you to spot that there's a potential issue on your horizon. For example, monitoring how long it takes your customers to pay you allows you to quickly respond if you see that number creeping up. Number 4, areas of strength and weakness are highlighted when you go through your reports. For example, your balance sheet indicates whether your business value is going up or down over time. Number 5, understanding your numbers also means you've got reliable financial information to base your decisions on. So when you're making decisions in your business, you don't want to be just plucking them out of the air. You want to be able to look back at your numbers and say, I know this is right because my reports tell me so. And finally, knowledge is power. The more you know about your business, the better your business is going to be, and the more powerful you're going to be in the business world. So here's an overview of the key reports that we will look at. Now, there are 6 here. This is quite a chunky bit of the webinar, and I'm not going to get too dragged into some of the detail. Some of you will be really used to looking at a profit and loss account. That tends to be the one that most people are most confident with. But we're also going to look at your trading account, your balance sheet, statement of changes in equity, your depreciation schedule or your fixed asset register. And we're going to have a quick look at the director's current account, also called the director's loan account. That's the terminology we tend to use at Panthera. And it's definitely something that people struggle with a little bit. So we're just going to spend a little bit of time today hoping to get a good explanation of that for you. So I've got a fictional company that we're going to use as our explanation today. It's called the Amazing Birthday Cake Company. I thought birthday cakes were quite a topical one for us just at the moment. And the Amazing Birthday Cake Company, we can see, it's a company that's making cakes. So it's buying in things, making them and selling them back out again. And we're going to have a little look at all of its financial reports as we go through. So we're going to start with your trading account. So your trading account tracks your sales, variable costs. So there's a cost that change as you make sales, and your gross profit to calculate the return you're achieving before you deduct your fixed overhead costs. So I've used quite a lot of accounting terminology there. Gross profit is that top profit. So your total amount of your sales, and sometimes we'll use the terminology sales, revenue, and turnover, all as interchangeable terms. So if you hear any of those three, you know, we're talking about the things that you've sold, the amount that you've made in sales. And your gross profit percentage indicates whether your margin, that's how much you make on each thing that you sell, whether your margins are improving or deteriorating, which is why it's an important report for us to look at. You can track your results across different divisions or product lines by using multiple trading accounts. Now, if you use Xero, you can do this using tracking categories. And sometimes our clients will split up their business into geographies. So for example, they might want to see how they do in different counties or different areas of the world. And you can use that using tracking categories within Xero. So you can make a mini trading account for each type of area or for product lines, or if you've got a divisional business, you can do it like that too. Small adjustments to the items in your trading account can have a huge impact on your overall results, which I'm going to demonstrate to you now. So here's our trading account for the Amazing Birthday Cake Company. As you can see, they've got sales of just over £1 million. They've got cost of sales of 300,000 or so, and total direct costs of 450,000. So you can see your cost of sales. So in this business, that would be buying in things like flour, sugar, and anything else that goes into making your birthday cake. So that's your cost of sales. You've also got direct costs. So that would be delivering those things, maybe the cake boxes that your cakes go into. Those are the sorts of things that fall into direct costs. You can see you've got a gross profit on this business of nearly £250,000, and the gross profit percentage is 24%. So let's say this company undertakes a bit of coaching with their accountant, and they're looking at strategies to increase that gross profit percentage. So one of the things they look at is customer retention rate. And so they say, if we could hold on to 10% more of our customers, what effect would that have on our sales? So going to have a look at doing that. Alongside that, they're going to look at having a renegotiation with some of their direct suppliers, and they managed to save 5% on the costs of the things that are going in to make those cakes. And they also managed to negotiate 5% discount with their delivery drivers. So they're spending just a little bit less on delivering their goods, and they're making a little bit more by holding on to their customers, by having a better retention strategy. So when we do all of those things, so it's a 10% change on sales and shaving 5% off your cost of sales and your direct costs, you can see the amazing difference that can make in the business. So on this particular example, £140,000 more gross profit than before, just by those small percentage changes. And overall, that gives you a 35% gross profit margin, as opposed to the 24% we were seeing before. So you can see how small tweaks in your trading account can really help you to have a much healthier business. The next one we're going to look at is the profit and loss account. This is probably the one that most of you are most familiar with. It's also sometimes called an income statement, and it shows all your earnings and costs over the year and tracks the overall performance of your business. It matches your income and your expenses for the same period. And we make some adjustments to this. So these are sometimes called accounting adjustments. And that those adjustments are to do with timing differences. So for example, if you charge your clients for something in December and you don't actually pay out for some of the associated costs until January or February, we like to make sure that the timing of those two things matches when we're writing accounts, so that it's easy for you to compare period by period. You might also have adjustments for money that's not been received yet, and those are called debtors. It's important to remember that profit is not the same as cash. And this is my big headline from this webinar. Profit is not the same as cash. The profit shown in your profit and loss account includes non-cash expenses like depreciation. You must ensure you've got sufficient profit to cover cash costs, such as repaying loans. And for lots of you, you might have had a bounce back loan or a CBILS loan. This is really, really important. That doesn't show up in your profit and loss account, but you do need to have enough cash to cover it. You might also have things like asset purchases that you need to make, and you need drawings for yourself as a business owner, which are going to come out of the business and again, not show on your profit and loss account. So your profit and loss account provides a framework to benchmark your results by using percentages or comparisons between years to compare your business performance to itself and to similar businesses in your industry. And if you don't know how to do that, again, that's something that we do for lots of our clients. We have some benchmarking tools so we can help you to see how you're doing compared to your peers. Businesses are generally valued using a multiplier of their earnings, sometimes your profit. So your profit and loss account is a fundamental driver of the value of your business. And the higher your earnings in the business, the higher the value of the business is. So if we're wanting to grow our businesses and we want to make them more valuable, we have to understand our profit and loss account. So let's go back to the Amazing Birthday Cake Company. Here we can see an example of a profit and loss account. That gross profit line we've brought over from the trading account that we saw just a few slides back. So we've brought that gross profit over, and then we've got all of these overheads that sit a little bit further down on the P&L. As you can see, this company is currently trading at a loss. And when you see negatives on any sort of accounting reports, it's because it means a loss generally. And so when you're reading these, you can see down at the bottom losses in brackets, and then the number after it's in brackets. So we know that that's £113,000 of loss here. So let's say this company takes a review of all of their expenses. They sit down with their accountant and they go through line by line on their P&L and they say, where might we be able to make some savings? So accountants tend to have really good understanding of what is normal in an industry for something like insurance or perhaps for their rent for their offices. So we sit down together and we say, okay, we reckon you can shave 5% off your insurance by going to a broker and asking for some comparative deals. And then we've suggested to these guys, they go to their landlords and renegotiate their rent because it's too high for what we'd expect in the area. And they managed to renegotiate both of those things and save 5% on just those two areas. By doing that, they've saved £597 here and nearly £3,000 on the rent. And you can see up here, because of all that time they've spent with their accountant, they've also put their accounting bills up. So those things net each other off. But with all those savings we made over on the trading account by increasing sales and decreasing cost of sales, overall, we've managed to improve their bottom line, that net profit, also sometimes called a bottom line, by £138,000. And that's just by spending a bit of time looking at where we can make savings, by really understanding what's going on in the numbers here. So we can see those different lines there, 138,000 on the net profit. Moving on to the third report that we want to look at, this is the balance sheet. Your balance sheet can sometimes be called a statement of your financial position, and it provides a snapshot of your business's financial position at a specific point in time. So different to your P&L is over a period of time. If you're doing it for your year-end accounts, it's normally over a 12-month period. Your balance sheet is always at a specific date. So if, for example, your year end is the 31st of December, your P&L is going to talk about a period from the 1st of January to the 31st of December, and your balance sheet that goes alongside that will just take a snapshot of your business on the 31st of December 2021, if it's this one that's just closed. And it's going to also show you the 2021, so you've got some comparatives there as well. Your balance sheet measures the net worth of your business, which is your assets less your liabilities. Assets are things that are worth something to the business, and liabilities are things that the business owes out to other people. It also shows if your business is solvent. So if your liabilities are greater than your assets, then the business is insolvent and urgent action is needed to fix this. And as a director of a limited company, it's your duty to make sure that you take that action. You can compare different periods to determine whether the business's net worth is increasing or decreasing between years, and that helps you to track the strength of your business. And the stronger your balance sheet, the easier it is for your business to survive a downturn or for some adverse things going on in the climate. We might be seeing a little bit more inflation than we've seen for a long time. So having a good, strong balance sheet can help you weather that storm. And it also provides a basis to calculate the key ratios, such as debtor days and inventory days, that we use to see how we're doing with our business. Sometimes these are referred to as KPIs, that's key performance indicators. Now, don't worry about how we calculate those, because after this webinar, there's a giveaway that we've got. It's a freebie, we'll send it out to you, and it's a report on how to understand these reports we're talking through right now. And each of those key performance indicators and key ratios are explained in that document, and it also goes into why you would want to track them. So it's a really, really good read, super helpful, and it means you don't have to write all of this down whilst I'm talking. So here we come back to the Amazing Birthday Cake Company. We're looking at their balance sheet, and as you can see, the company is currently insolvent. If you look down at the bottom where it says net assets, they're negative. It's got more liabilities than it has got assets. You can see these two figures on the screen now. This means the company can't pay its short-term debts from the limited cash, debtors and stock that it's got on hand. And that means that we've got to do something urgently. So if you don't look at your balance sheet at all until your accountant hands it to you at the end of the year, you wouldn't know that this position has happened, perhaps for 12 months, which is why it's really important that we don't just focus on the P&L, we also look at our balance sheet on a regular basis. So the business needs an injection of, you can see the figure here, £305,000 at least, and that could come in the form of share capital. So it could sell some more shares, or a shareholder loan. So that would be coming from the shareholders, putting some money in order to get the working capital for the business to get them through this bump. Assuming the company can resolve these urgent solvency issues, there are other areas for improvement too. So over the long term, the company could implement strategies to reduce their debtor days. You can see here, to calculate your debtor days, we do debtors divided by sales times by 365 days. With the figures that we've got on this balance sheet, the debtor days are currently 26. So that tells us that on average, it's taking customers 26 days to pay their bills. If they updated their terms of trade and said to their customers, we're not doing that anymore, from now on, you've got to pay within 7 days, and they managed to persuade their customers to just shave 5 days off that 26-day average down to 21 days, they'd have an additional nearly £14,000 in the bank because they've just sped up the time it takes to get paid. You can also have a look at inventory days. So inventory days is how long we hold on to stock. We do it in the same kind of calculation. So at the moment, the inventory days here are 74. So let's say they had a review of their inventory processes and they managed to keep their stock moving a little bit faster. They bought a little bit less and didn't have it sitting on the shelf for so long. And they managed to reduce it by, let's say, 9 days. Then that would save them another nearly £8,000 to have £8,000 more cash available to pay for things and to use for working capital. So while this cash flow gain, it's nearly £22,000, doesn't fix the solvency issue, it demonstrates how much cash could be saved with just a little bit of help from their accountant to say, let's look at these couple of financial indicators and tweak them a little bit. So we're on to the statement of changes in equity. Now, very often we see customers, clients of ours, who don't look at this report at all, or who very rarely look at it. Now, the statement of changes in equity shows what happens to the profits from your business, and it links your profit and loss account and your balance sheet together. So it's a really good explanatory report. And if you're not getting one, it's always worth saying to your accountant, please, could you add that one in just so I can see what's happening to the profit year on year. So what can happen to profit? It can get paid out as a dividend. It could be kept in the business as retained earnings. And the statement of changes in equity represents the net worth or value of the company. So it's a key indicator of the financial health of the business. It shows whether a company is solvent. And remember, if the company has more liabilities than assets, it's insolvent. And that means funds need to be paid into the company. So here's an example statement of changes in equity. This company's got accumulated losses, so that's making a loss every year, and they're sitting on top of each other for at least the last 3 years, because you can see here where it says opening balance at the beginning of 2019, it had £139,000 of loss. Remember, brackets means a loss. And that's just getting worse and worse over time. There's no money in this business to pay out as dividends, because you can only pay dividends out of retained profit. And there's no money to reinvest into the company to buy things like new assets. So let's say it needed a new mixer. It doesn't have the cash to do that, which is why it's really important that this business pulls itself quickly out of its insolvent position. The directors have to take action now to increase the profitability of the business. Next report that we look at is the director's current account. Now, very often this is called the director's loan account, and it's because there's loans from the director to the company, or alternatively from the company to the director. It can help you to monitor your personal expenditure from the business, and for businesses with more than one director, it maintains a balance of the amount each director has either introduced or taken out from the business. It shows how much the business owes to each director, and if the account is overdrawn, and you might hear accountants talking about an overdrawn DLA, director's loan account, and when we see that, we get a little bit nervous because it has a tax implication for you. So we try not to let director's loan accounts or director's current accounts get overdrawn. But if it is overdrawn, it means the director has taken out more than they've put in, and now they owe the money back to the company. So they either have to repay their loan, or the company can increase its profit and therefore pay the director a bigger salary or a dividend. If it's not making a profit, it can't declare a dividend. So it's really important that we keep an eye on what's happening with that director's loan account, and we don't let it get out of hand. If your director's current account or loan account is overdrawn, it's important to get advice from your accountant as soon as possible to avoid that big tax bill that can come your way from it. So here's an example of a director's loan account. You can see it's Mr. Doe is the director. He's got an opening balance. That's money that he's put in to start the business or is lent to the business, may be paid on his personal credit card for some expenses, and those all go into the director's loan account. He's put some funds in during the year and then had some money out. And you can see each of those lines is shown on this director's loan account. So it's really important you keep an eye on it so you can understand as directors how much the business owes to you or if it owes you money back. You can see there's the opening balance. The funds introduced during this year was £2,000, and that means that the total balance over time has increased by decreased by £9,000. So the total director's current account is sitting at 21,000. Last of these reports I want to just have a quick look through is this fixed asset register. So there is a fixed asset register in Xero. If you're using Xero, you really should use the fixed asset register as well. Lots of people take it out to Excel and keep a link over there, but actually Xero does this beautifully. And it also means that at any stage, if somebody says, can I see your fixed asset register? And that can happen, perhaps the bank will want to look at it if you're looking for some borrowing, or if you're looking at selling anything that you own, your fixed asset register should have an up-to-date picture of what you've got in the business and how much it's worth at that stage. So if you keep it in Xero, it means it's up to date all the time. The fixed asset register provides a basis for keeping track of the assets, and it can be a useful guide to determine when assets need to be replaced, especially for things like computers. You know, if they're coming up to 3-4 years old and they're becoming obsolete, your fixed asset register will be able to tell you that. It's also useful when you sell your business, as it records the current value of all of your fixed assets. So here's a picture of a fixed asset register. Now, I'm not going to go into a lot of detail here because very often your accountant will do most of this work for you, but it's important to see that here in your fixed assets, you've got a list of all of those different things that you might own. So software, computers, iPads, food processors, etc. So there they are at the cost when they first entered the business. The opening NBV, you might see this when you look at your schedules. NBV is the net book value. So that's the value that they've got, and this is the opening net book value. So at the beginning of the year, this is how much those assets are worth at that point. And then we look at any purchases we've made during the year, we add them into the fixed asset register. And if we've got rid of anything, we also remove them using that disposals column. You depreciate your fixed assets, and in this business, the RB here means reducing balance. And if you see RB or SL, SL is for straight line method, And reducing balance means that we take the same percentage every time from the net book value. And again, your accountant will help you make the right decision as to how fast to depreciate your assets. Then we charge the depreciation for the year, and that depreciation goes onto your profit and loss account. And that's one of those accounting adjustments we've talked about. And then at the end, we have a closing net book value. And that's what sits on your balance sheet for your fixed assets. And that's how we know how much your fixed assets are worth. So that's the last of those reports. I've done a whistle-stop tour through them because I've got other things I want to talk about with you today as well. And big one is the difference between profit and cash. So it's really common for business owners to get frustrated that their bank account doesn't seem to reflect their profits. Tori, why is my profit and loss account not the same as my closing bank balance is a question I get asked probably the most out of everything. It's really essential that you understand the difference between profit and cash and why a high profit doesn't necessarily result in more cash in your bank account. So a profitable business can go out of business because it's starved of cash. And actually, that's the most common reason for small businesses to fail. It's not because they're unprofitable. It's because they don't have enough cash to get through their business cycle. A business running at a loss can survive because its directors put money in to get it over that hump, or it borrows from the bank. So you can fund yourself over that loss period, but you can only run out of cash once. Once you've run out of cash, you stop trading, that is the end of your business. So in other words, cash flow is the reality for every business, and it's the most important thing that we can track. I'm just going to help to demonstrate why those two things are different. Hopefully this will help you to understand this a little bit better. So let's consider a few items that we see going in and out of a business. So let's start with VAT. VAT affects your cash balance, but not your profit. Your profit and loss account is always done excluding any VAT. So VAT is not shown in your P&L, it just hits your cash. Loan repayments. So they affect your cash balance, but not your profit. When you repay a loan, it all goes off your balance sheet. Interest on your loan, however, goes on both sides. So we recognise the cost of the interest on your profit and loss account, and we also have an effect on the amount of cash that we hold. You know, it has to go out of the business. Asset purchases, they only affect the cash side of your business. They don't show up on your profit and loss account at all. And also, when you sell your assets, you get some money in from selling the assets. That doesn't hit your profit. Depreciation only affects your profit. It has no effect on your cash. So you can see, even if your business achieved a healthy profit, we've got all of these other items on the cash side that can bring down the amount in your bank account. So once you've paid your tax, you've made your loan repayments, and you bought your new assets, you could end up with no cash in the bank, but still have a profitable business. And that's how those two things get out of sync with each other, and why there's a difference between them. The Business 101 cycle is another really useful way to demonstrate this difference between profit and cash. So first, the owners need to invest money into the business. This money can then be used to purchase the assets needed to run the business. So when you first start your business and you perhaps buy all of your office equipment, and then you buy the things you need in order to make what you do, that's that first asset purchase. The business may need additional funding to buy all the assets they need. So they might make a loan, they might take a loan and finance the purchases that way. The assets are then used to generate a profit. You can increase your profit by growing your sales or your margins, like we saw when we were talking about that trading account. But overhead expenses can drain your profit and result in a loss if they're not managed. And that's why it's really important to keep an eye on those overheads at the same time. The profit then gets turned into cash. That's what happens when you get paid. Drains on your cash include slow collection of debtors, that's why we look at debtor days, high inventory days, that's holding on to too much stock, making loan repayments, making tax repayments, and payments to suppliers. A business can achieve cash gains by collecting their debtors faster, by decreasing the amount of stock they're holding, negotiating longer payment terms with their suppliers, and reducing their tax bill. The owners then take cash out of the business as drawings, or perhaps director's loan repayment, and the remaining cash can then be reinvested into the business to purchase more assets and to generate more income. And the aim is to go through the cycle as quickly as you possibly can, because that increases your return on investment. So the faster you can make that cycle go round, the healthier your business is going to be. So that's one of the things to take away, is to think about what your Business 101 cycle is, how long that runs, and what it is you could do in order to reduce it. And if you're writing notes, if you've got any thoughts now, just pop them down, because at the end we're going to talk about what you're going to take away from today and what actions you can take. So after cash flow, which is my absolute number one of your know your numbers, is to understand your cash flow, business value is the next important measure of business success. So part of knowing your numbers is understanding and measuring the drivers of your business value. These drivers might be monthly recurring revenue. If you're in a business where your clients come back to you month on month, then that's a really important number to track. It could be how much your revenue is growing by. So if you're growing your business right now, you want to know what that percentage growth looks like. It could be revenue per client. So how much revenue do I get from each person that I look after? It might be your sales, your total sales figure, or it might just be that profit line, your gross profit or your net profit line. And it's going to be different depending on what industry you're in. So that's why it's really important to talk to your accountant, have that conversation about what is it that is the driver for my business, so you know what to track. When we're thinking about enhancing the value of your business, you've got to first develop and implement a clear plan and document your organization structure and roles within your business. Next thing you can do is establish cloud-based real-time reporting. Those of you using Xero have this already. That is what Xero is. It allows you to do real-time reporting. You can have a look at your bank balance as at yesterday and run a balance sheet as at yesterday, assuming that you've got your bank record done and up to date. And that allows you to make really good decisions because you're using up-to-date data. If you review and document your systems and processes, it's going to ensure your business is running as efficiently as possible. You want to reduce your reliance on the owners of the business. That's those people like you. You want to stop everything being on your plate and spread it out between your team. And that helps to enhance the value, because if you're thinking about selling your business or moving your business perhaps over to something like an employee ownership type of structure, the business's value is going to be based on how easy it is for the business to continue without you. So making sure that your systems and processes work whilst you go off on holiday or you take some time off is a really good like trial run for how it's going to work when you want to exit your business. And finally, we've got to identify and manage risks. So that means that they can be mitigated before they become an issue for the business. It's really important to do that risk assessment in your business and to do it regularly, because the risks have changed. The risks that we saw at the beginning of 2020, when we weren't quite sure what was going to happen during lockdowns, some of those risks have been mitigated and new risks have come into the workplace. So it's really important you keep up to date with that. So as we've seen throughout this webinar, the profitability, cash flow, and value of your business all affect you personally. If your business is unprofitable and doesn't have much cash available, you aren't able to pay yourselves and to fund your desired lifestyle. And you may find, in fact, that your own personal money is wrapped up in the business as a loan in order for it to get through its cash flow cycle. So there are a few other things you can do to help to protect your assets. And I'm just going to quickly run through those now. So the first thing, and something we advise all of our clients to do with a business of a certain size, is to set up your business as a company, because it limits your personal liability. And what goes along with that, limiting your personal liability, is also being very aware of borrowing where you are asked to give a personal guarantee, because that means that your personal assets, your house, perhaps your car, other things that you own, could be at risk if the business doesn't keep up its repayments. So we're really cautious about your personal liability for business debts, and we want to limit that as much as possible. You should consider who you want to be a director of your company and which assets are held personally by the different directors. You want to look at the security that loans have got, so those personal guarantees, or security over assets that the business has. So sometimes loans will take a guarantee over some of the plant and machinery that you've got, for example. So just being really aware of how your assets are protected in that process. The alternative ownership structures for high value assets. So this may be, if you own the premises for your business, you might want to check that that's the right structure, that the business perhaps should have its premises owned in a separate structure in a different limited company in order to protect that asset. And those are the sorts of things we would talk through when we're looking at financial planning for the future, or looking at tax planning for businesses over a strategic time frame. So definitely get your accountant involved and have those conversations. Reviewing your terms of trade. So terms of trade is just a posh way of saying your agreement with your customers. So however that's written out, if you've got T's and C's, have they been reviewed recently? Do they have the right protection for you in there? Are you asking people to pay you at the right time? So, you know, if you wanted to bring your debtor days down, have you been saying to people you can have 30 days to pay, but actually that doesn't work for your business anymore? You really want to tell them to pay within 7 days? Then taking a look at your credit policies be really, really useful. That's something that we often get one of our preferred suppliers to help us out with. We've got a couple of people who really are experts in credit policies, and they can come in and have a review of that. So if you want to have any help with that, just drop us a note and we can put you in contact with the people that we think are really good at that. Insurance. So is your insurance sufficiently protecting you? Have you updated your turnover with your insurer recently? When you get sent your insurance pack, do you just tick it all, or do you say, actually, I've now got 10 employees when I did have 5 employees? Really, really important to make sure that those are up to date so that you're properly protected. So financial planning, have you undertaken any financial planning recently? Have you managed your personal wealth outside of the business? Again, this is something that we would normally suggest our clients talk to an IFA about, making sure that there is a plan for pensions, for savings, and making sure that all of the things you want to do in your personal life can be funded. And it's really useful to have that information when you're thinking about setting your budgets for your business, so that you can feed that data back in. How much does the business need to provide me in order to fit my personal plan? And then working backwards. So sometimes we call that a bottom-up budget. So we start from the profit it needs to make and work out then how many sales you need to make or what pricing you need to put in place so that the business supports your lifestyle goals. And finally, planning for the future. So this is sometimes called estate planning. Do you have an up-to-date will? Have you got powers of attorney in place? Is there a clear plan for transferring your assets to the next generation? It's really, really important that you have a review of this. And again, we've got a great will writer that we like to work with, and we can put you in contact with them. If you're a business owner, it's fundamental that you have a will in place. Even more important, if you have a business that you share with perhaps a partner and you've got a 50-50 shareholders split, that's absolutely imperative that you have a shareholders agreement in place, because if, God forbid, something happens to one of you, you need to know what happens to those shares. So if you've got that set up and you don't have a shareholders agreement in place, you don't have powers of attorney or a will in place, that should go onto your list of things to do after this webinar, is to get in contact and get that stuff sorted out. This is not an exhaustive list. So we've spoken about a few different ways of protecting your assets, and there are lots of other things that we can help with. So if you are worrying about protecting your assets, just give us a shout. Okay, I have spoken very fast and I've thrown a lot of information at you. So I'm just going to take a quick breather and say, how does everything that I've talked about already today come together as best practice? So every business, in my opinion, should have at least these 3 essential tools. We talk about this quite a lot at Panthera. Sometimes we call this the tripartite. It's the things that I think every business owner must have in place in order to keep their business on the right path. So the first one is an annual business plan. That can just be a single sheet of paper. It doesn't have to be these enormous books of paperwork, and it shouldn't take you forever to write it either. It has to be an accessible document. At Panthera, we write a business plan on a page, and it's got a mixture of financial goals and non-financial goals, and then it's got some accountability built into it as well. You need an annual forecast. You need to know where you're going over the next 12 months. And you need in that annual forecast for it to be broken down into a monthly basis, so you can check that you're on track with what you thought you were going to do, so that you can hit your numbers at the end of the year. And the third thing you need is ongoing reporting and accountability. Now, if you're in Xero already, you've got some really great tools in there to help you with your reporting. So you can pull out your P&L and your balance sheet really, really quickly. And if you don't know where to find those, then just jump on a call with us and we can point those out for you really quickly. Make sure that you've got accessibility to it on a regular basis. So I would much rather a client looked at that every week, for example, than they left it to the end of the year and then went, gosh, that was a surprise. I didn't expect my business to be in the shape it's in. The accountability process comes from your goal setting work and perhaps some form of coaching or mentorship, along with sharing your numbers to your board meeting. If, for example, you're in a mastermind and you do that, or even if it's just a couple of you on the board, so you might have a couple of directors in the business. I often find this with husband and wife teams. It's really good to put a marker in the diary that says, this is our board meeting. It may mean that you go out to the pub with your board pack and you sit down and you just talk through it before you have dinner. That is a really good process to get into. Now, if it's just you and your business on your own, I still think you should put a board meeting in your diary. It sounds a bit quirky, but you need to sit yourself down and go through those reports at a time when the phone's not ringing and you're not busy dealing with operational items. If you can get yourself into that habit, then as your business grows, you've already got that system built into place, so that when you do bring other people into the business, when you get new directors, when the business grows, you're able to just continue to do that with the rest of your team. Using your group, you know, if you've got those people around you to hold you accountable, really works. So don't shy away from bringing your numbers to the table. I know quite a few business owners that can be a little bit cautious about sharing numbers. Sometimes they either feel embarrassed or they're not really sure what they should share with staff and what they shouldn't share with staff. Some of that's going to do with, you know, how comfortable you are with your figures. But I think you should really be encouraged to share as much as possible with your staff, especially those numbers that they have some impact on. So, for example, I know lots of businesses who will share their turnover, that's their sales or their revenue line, and they'll share their gross profit margin. So those are the things that often staff have got some say about. So they may be able to say, actually, I've seen that this supplier is cheaper than that supplier. Could we do a swap? Or alternatively, I've had this idea about how we could shave a day off how long it takes us to make the thing that we sell. Can I bring it to the table? And if you can encourage your staff to bring some of those ideas to you, it can be really, really valuable, but they won't know that that's worth doing if you don't share your numbers with them. So that's part of knowing your numbers. It's not just you knowing your numbers, it's your whole culture within your business, having that idea that sharing numbers is something that you do and is important, and you're tracking it for a reason. It's not just to beat people over the head with, why haven't you hit your sales target? It's to say, what can we do in the business to improve? And when you've got other people in your business, you should use that amazing asset of their ideas to really help you to grow your business. Knowing your numbers is just the beginning, as it allows you to then improve them and ultimately achieve your goals for your business and for your lifestyle as a whole. So where do we go from here? I know I've been saying this for about 3 years now. Where do we go in these challenging times? So it's been challenging for different reasons, but just because it feels like we may be coming out of lockdowns and other tricky things, I don't think 2022 is going to be any less challenging than 21 or 20 was. We've got some clear up to do for some businesses. There are some industries who are still under some restrictions, and we're going to see, I think, a bit of a crunch during this time when the government support starts to dry up, and people are having to trade through on their own a period where we still don't have consumers with a lot of confidence and increasing prices that we're going to see over the next 12 months for sure. So we've got lots of things that are going to be challenging for us. And my aim is to help you take what you've learned today and implement some positive change in your business before you get hit by some of these challenges, so that you're really ahead of the game. Now it's time for you to decide what you're going to do. So if you can take a few minutes after this webinar, and I'd say just 15 minutes with your sketchbook or your notebook, however you like to take those notes, write down 3 actions or projects that are going to add value to your business. If you want to share those with me, I would be absolutely thrilled to see some of those actions coming back to me. You can just ping us an email, you can respond to the email that you get after this webinar, and you can just let us know what they are, and we would love to hold you accountable. So if you've got those and you know that accountability is something that you struggle with, you don't have an accountability buddy or somebody to mentor you through that, drop them to us. Even if you're not a client, really, really happy to hold you accountable, to check in and say, how are you doing with those goals? Are you managing to move forward? What's stopping you from getting there? it's important for you to think specifically about the problems you're facing in your business just now, or the ones that you can see coming up, identifying them, and then using them as an opportunity to create a project to fix them would be really smart. So I know, for example, one of the projects in my business at the moment is about debtor days. That's become quite tricky for many service-based businesses, I think, during that COVID time, where you might have been quite generous to those customers that you knew were struggling, that either they were shut down, maybe they're in hospitality. We've got clients in those kind of areas. And so we said, okay, let's just give them a bit more leeway on payment. And so for lots of companies, 2022 is the time to get that back under control. So for example, in Panthera, debtor days is one of my projects for the next quarter. Think about what some of your projects could be and how you could improve your business through measuring those numbers. The one thing I would say is doing nothing shouldn't be an option. So spending an hour with me on a webinar, I appreciate massively. I know how important your time is, but if you go away and don't do anything with this, then it's a wasted opportunity for you. So just making sure you've got some actions to take away will really, really help you to achieve some value from today's webinar. So how can I help you? Now you know what you should be doing as best practice in your business. Here's what I can do. So if you don't currently have a business plan, we can help you to develop one. And we do that for clients and for non-clients. So if you just wanted to do a standalone business plan with us, we can do that. When we do business plans with clients, we take about 4 hours as a block. Sometimes we split it into 2-hour sessions with people, and you can either come to us or we do it over Zoom, depends on how you work best. It's really fun, it's really interactive, and we'll just get stuck into your business. If you feel like you're absolutely up to your eyes in operational work, and we find lots of business owners feel like this, never a moment to step back and think about strategy. Coming out of your business and spending some time on your business plan, 4 hours out of the business can be transformational. And we've really helped a lot of clients to go through that. So if you want someone to hold your hand through a business plan, that is something we can do for you. We can also do an updated cash flow forecast. So if you're worrying about how you're going to pay for things over the next year, if cash flow is one of those things that wakes you up in the middle of the night, I know for many directors of businesses, that's the one thing that keeps them up at night. We can take away some of that pain by helping you write a cash flow forecast. We can also create management reports each month. So those things we looked at, profit and loss account and balance sheet, we can do a bit more than that. So we can pull those and create you some key performance indicators, looking at those ratios, the ones that we think are important for your business, and help you to track those month on month. And finally, we also do an absolutely free 1-hour meeting for clients and people who aren't clients of our business to go through how they might use what we've learned in this webinar and really drill down into those things that they should be concentrating on, and to give you some giveaways. So if any of those things are of interest to you, just drop us a note after this webinar and we'll be really happy to get you booked in. We know it can be really difficult to commit to spending money right now. So all of these services include an assessment as to how you can improve your profitability and cash flow, so that there's going to be a great return on the investment that you make in them from the process over time. And we like to think that we'll at least make 3 or 4 times the investment that you make in something like a business plan by the improvements you make in your business. So don't let that be a barrier to you joining us. If you wanted to maybe pay for a business plan over time, that's the sort of thing that we can do too. We just don't want business owners to be struggling on their own. We know that there's loads and loads of benefit from doing this next section. So just reach out to us and we'll see what we can sort out. And just to give you the little bit of terms and conditions, which I always have to say when I run these webinars, the information in this educational webinar is general in nature, and it's no substitute for specific tailored advice and support. We love working with people one-on-one, and then we're able to actually dig down into your business and take action that's actually going to impact on your business specifically. Okay, so I am ready to take some questions. I'm just going to end this slideshow so that I can see what's going on. Hopefully Vicky is there as well. Vicky, I've got a couple of questions that I've seen pop up. Have you got any that you wanted to share to me before I get on with these ones?
Not so far, yeah. Okay,
brilliant. So one of the questions that's come through on the Q&A is about the difference between the annual accounts, those accounts that you get to send off to
you're still sharing your screen, Tori.
Oh, Fantastic.
Yeah.
Thanks, Vicky. So this is the difference between the annual accounts and the accounts that can be produced throughout the year, like your management accounts. So the annual accounts contain year-end adjustments for things like depreciation, tax, splitting out your interest, and the principal on the loans, making prepayments, and you know, all of this jargon that you'll hear from accountants. These aren't things that you need to worry about particularly. Your accountants will make those changes for you in order that your year-end accounts are matching on a timing basis, and that they're showing a true and fair view of your business at the end of the year. So they are always looking backwards, so they look over the last year, whereas when you're doing something like monthly management accounts, they're going to be looking at what's happened just over the last month, and they're much more up to date. So they're giving you a snapshot of your business as you go through the year, and that's why we think they're really, really important, because it means that you can make decisions at the right time. You're not waiting until you've got your year-end accounts and then saying, well, I wish I'd done that back in March last year, when I could see what was happening in the business. So that's the difference between those two. And then we've got one other question, which is, what's the difference between a markup and a margin? So we talked about margins a little bit when we looked at the trading account and when we looked at the profit and loss account. We've talked about gross margins, and we've talked about net margins. So gross margin is that one that we saw in the trading account, which is just about the amount that you make on the thing that you sell. So we look at our sales, we take off our cost of sales and our direct costs, and that gives us our gross margin. And then once we've taken away the overheads, we then end up with our net margin at the bottom. So the markup, when we're thinking about in pound terms, is the same as the margin, in that both are the difference between the cost price and the selling price. But in terms of percentages, markup and margin aren't the same, just because the way we work out the percentage. So for example, if you bought something in for £75 and you sell it out for £100, your markup is 33%, because it's 100 divided by 75. And so you've got that 33% markup, and the margin is 25%, because that's the profit, the 25% profit divided by the sale price of 100. So that's why those percentages come out as different things. And it's because of how you do the calculation. And you'll find on the report pack that we're going to send out as a freebie when we finish the webinar, you'll find the calculation of that written out. So it's kind of hard to understand it when it's being spoken about, but if you can see it on paper with an example, that makes it much easier to get under the skin of. And so when you get that pack, have a little look through, and you'll be able to see those things about margins and about markups. Now, for some of you, you're not selling an item, you're selling a service. And if you're selling somebody's time, you also need to know what the margin is on the time that you're buying in. So you're paying people to do something, and then you're selling that thing back out, perhaps at an hourly rate. You need to understand what the markup is on that hourly rate. And especially, I know we've got a few people here that are in the care business. So when you're thinking about the markup on the hourly rate, it's not just on how much you pay somebody per hour. So you may be paying, let's say, £12 per hour, but the cost to your business is actually the £12 per hour, plus the national insurance, plus the pension costs, plus the training costs, and probably the PPE. And when you add all of those together, you then need to make sure that there is enough of a markup on that cost base in order to give you a profit at the end. So if you're in one of those sorts of businesses where you're selling time rather than an item, you also absolutely have to keep an eye on those margins, and we can help you do that if you're stuck on it. Vicky, I think I just saw another question pop up.
Yeah, so won't a business with loans in place to be paid back over a 3 or 5 year period always be insolvent by your definition, because they can't afford to pay back the loan in one go? That's why they took out a loan.
It's a really great, yeah, I really like that question. Now, what I didn't go into when we were talking about balance sheet is the difference between current liabilities and long-term liabilities. Now, those two phrases have been changed a little bit in terminology. So sometimes it will say creditors due within 1 year and creditors due in more than 1 year. That's the terminology that you're going to find on your financial accounts, the ones that go to HMRC and to Companies House. And we changed that, gosh, I don't know how long ago now, in order to try and help people understand a little bit better what we meant by current and long term. And so a loan like the one you've just described, you'd have just in the current liabilities, just 1 year's worth of that loan, and the rest of it, anything that's due in more than a year, would fall into that long-term liabilities section. Now, when we have a look at our balance sheet, we often look at the net current assets. So that's current assets less current liabilities. And that number in there, in your example, probably wouldn't show an insolvent business because it has enough money in order to deal with its current liabilities, those things that are due within a year. And then the longer term part of that loan would sit below that. And when we're assessing a business's health, and very often if you're looking for funding, they're going to look at this net asset figure rather than looking at the bottom of your balance sheet, because that's going to give you that picture. Now, there was a change in legislation during COVID in order to allow businesses to continue to trade in what looks like an insolvent position without that being a concern, for exactly this reason, knowing that people are going to need to have these longer term, bigger borrowing than they perhaps would do usually in order to get through this period. So it's fine to continue to trade if you've got that long-term loan sitting further down in your balance sheet in that bottom section, because we know that it's going to take some time to pay that off. Yes, you're right. If you had all the money that you needed, then you wouldn't have taken the loan in the first place. So that's why we sit it down into the bottom of that balance sheet. Hopefully that answers the question for you, Greg.
Okay, we've got another one from Mark, which is, which numbers would you share with employees and which not? Net profit, for example.
Yeah, it's a really good conversation starter, that one. And there's no right or wrong answer to this. It partly depends on the size of your business and how involved each of your employees is in the decision making. I started my career working for a big water company, and they were very proud that they shared all of their figures with all of their staff. It didn't matter if you were a delivery driver or if you worked at the top of finance. Everybody sat down together and we went through the whole P&L and the balance sheet every month. And that was seen as quite radical at the time. It was quite a long time ago. But I think there's a lot to be said for that, because it means that everybody is on an education journey within your business to understand what's going on. However, sharing net profit when you're a small company that is probably taking out dividends, for example, to pay for your lifestyle, you may choose not to share all of that with your staff. You might not want them to know how much profit you're making because you might feel that they don't need that information, but also that they don't really have any way of impacting that bottom line. So they maybe have some impact at the top level. So you might just want to share sales figures. And I know lots of businesses that just run on sharing that sales figure because that's what they want to drive. You might want to just share that net profit figure because they have some impact on efficiency, wastage, those kind of numbers. And those things like overheads, like how much is your company car costing, for example, you might not want to share that with your staff. You might think actually it's not going to aid them at all and they can't make any difference to that decision, so don't share your net profit. I think you definitely want to be sharing some of those numbers. So I would say if you're feeling a bit cautious about sharing all of the cost base, go in at the gross profit line. So sharing sales and the gross profit, I think, is quite an empowering number to share with people. I know another business where they don't share the number in pounds, but they have a point system. So they say every new client that we bring in this kind of product range gets 2 points, and in the smaller product, in the cheaper product range, they get 1 point. And they use a way of tracking that says new clients in, less clients that have left, and is our number going up and down by a certain amount. So that's a way of sort of taking the monetary connection out of it. And if you think that might be more applicable in your business and you want to share a bit more detail with them, but you don't want to tell them how much money the business is making, that's another way of doing it. And I think that can be quite an effective answer to that problem if you're feeling a bit cautious about it. hopefully that's answered your question. Fab. Vicky, have we got anything else that we need to go about? I'm aware that we've just run over by a few minutes.
Nothing else has come in, no. I think maybe some people have had a problem getting the workbook, so if we can sort that out.
Yeah, not a problem at all. So if you haven't been able to pick up the workbook from the link, we will also send it out on an email after the webinar. So we'll make sure that you've got access to that. I'm just going to share my screen again. No, I'm not. It doesn't want to play. All I was going to share was a slide that said thank you. So thank you so much for taking time out of your day. I know lunch times for business owners are really, really precious. So I massively appreciate all of you turning out today. I hope that you've had some things to take away. We'll make sure you get that workbook. We'll also make sure that there's a recording available for you if you wanted to re-watch something that went a bit fast or you got distracted at some stage. And then just reach out to us if there's anything that we can do to help you to understand your numbers better. We absolutely love explaining this stuff to people and helping business owners on that journey. So thanks so much for your time, and I will say goodbye.
Thank you. Bye.
Thanks. Bye.